Welcome to Market Pulse. Look, today we're jumping right into a massive story, a huge bet being placed by the Fed. And this one, it could seriously shake up your portfolio and, well, the entire economy.
All right, so let's get right into it. The whole financial world, and I mean everyone, is holding their breath over one single question. What is the Fed going to do about interest rates? Now, a cut seems pretty much baked in, right? But that's not the real story. The real story is the crazy amount of conflict and political heat surrounding this thing, making it one of the most high-stakes moves we've seen in a long, long time.
So here's the setup. We've all been through this long, pretty painful fight against inflation with these super high interest rates. Now, the market is basically convinced a change is coming. It's not a question of if the Fed will cut anymore. No, the big questions now are when, and this is the really important part, by how much.
And if you talk to most traders, most big institutions, they'll tell you a September rate cut is already a done deal. It's the baseline. But listen, the real drama, the thing that's actually going to make the markets jump, it's all about what happens after that first cut.
Yeah, because even though that first move seems locked in, behind the curtain there is this massive tug of war going on. And it's all about how big and how fast the next cuts are going to be.
And you've got these two completely opposite camps. On one side, you have some really influential voices calling for some major cuts. We're talking 150, even 175 basis points. That's a huge 1.75% cut this year alone. But then, on the other side, you've got giants like Bank of America basically screaming, whoa, hold on. They're warning that if we cut too fast, we could inflate a massive, dangerous market bubble that's just waiting to pop.
And get this, it's not just outsiders arguing. The Fed itself is totally split down the middle. You've got the presidents of the San Francisco and Minneapolis Feds basically saying, yeah, we're ready, let's go. Then you have other officials, folks like Bowman and Waller, who, let's just say some people think might have political goals influencing their decisions. And to make everything even messier, that core inflation number just won't come down. It's still too hot, which makes Jerome Powell's job, well, let's just say I wouldn't want it.
Okay, so with all this chaos and uncertainty, what do you do? Where does the money go? Well, for a lot of people, the answer is to look at one of the oldest plays in the book, precious metals. We're talking gold and, of course, silver.
And the thinking behind this is actually pretty simple. When the Fed cuts rates aggressively, it usually makes the US dollar weaker. And when the dollar gets weaker, investors run to things that hold their value. Hard assets. So this exact setup could be the fuel for a massive, maybe even historic surge in the price of gold. And you can bet silver would likely ride that wave right along with it.
And you want to hear something crazy? Some analysts are throwing out a price target that is just staggering. $5,000 an ounce of gold. I mean, to put that in perspective, that's more than double what it's been trading at recently. It's a really bold prediction for sure, but man, it just goes to show you how high the stakes are for assets like this right now.
But okay, that's the shiny side of the story. There's a darker side to this coin. Let's flip it over and look at the stock market, the wider economy, because this is where the potential fallout from all this gets kind of scary. And yeah, this is also where things get wild for high-risk assets like crypto.
The big worry here is that if the Fed cuts rates too much, it just floods the system with easy money. That creates this huge bubble, not just in the big indexes like the Dow or the S&P 500, but it could also pump up these massive, totally unsustainable rallies in more speculative stuff. Think Bitcoin, Ethereum, you name it. And the scary part is, it's all built on cheap money, not a strong economy. Some people are even whispering about a parallel to 1929. Yeah, that 1929.
But maybe the biggest boogeyman isn't even a crash. It's this nasty economic problem called stagflation. And let me tell you, it is the absolute worst of both worlds. It's when the economy just stops growing, it stagnates, but at the same time, prices for everything you buy keep going up and up. So your money is worth less and less, but the economy is dead in the water. It's a total nightmare scenario.
So you can see how the dominoes could fall, right? It starts with something that sounds good. Hey, rate cuts. But then that easy money sparks inflation all over again. That inflation pushes people into risky assets, fueling a bubble in stocks, especially tech on the Nasdaq. And suddenly, the whole system is teetering on the edge, vulnerable to a major crash.
So what does all this mean for your money, for different assets? Well, depending on which way the Fed jumps, the outlooks are completely different. It's really a tale of two futures.
I mean, look at this. It's pretty striking. Gold looks super bullish, right? It's set up to do really well if the Fed cuts. US stocks, yeah, they could keep climbing, but they've got this giant warning bubble risk sticker slapped on them. And that same thinking applies to crypto assets, like Bitcoin, Ethereum, and Ripple. They could absolutely fly on all that easy money, but the ride would be incredibly volatile, even more risky. But then, look at oil. It's bearish. It's pointing down. That's a huge tell. It suggests there's a real fear out there that the global economy is already hitting the brakes, no matter what the Fed does.
And so it all comes down to this one final question. Is the Fed going to follow the economic data and do its best for the long run? Or is it going to cave to all this political pressure? The answer to that question is going to define the markets for a long, long time. Hey, thanks so much for joining us for this explainer. If you got something out of it, we'd really appreciate it if you'd subscribe and give us a like.